That's why you hedge. I should have said stop before I got up, but I forgot. I disagree completely. I think inflation is going to pick up and get significantly hotter over the next 6 months. I think the asset bubble reinflating, which it's done significantly since November, is going to drive up consumer confidence. It's going to drive up consumer demand, and it's going to increase the price of shelter. All of which will be additive to inflation until May, when the healthcare costs are recalibrated and weighted against 2 years of upside increases in healthcare costs versus weighted against a year of downside and a year of upside. At which point, healthcare will also become additive to inflation. And I think the ongoing conflict in the Red Sea is going to drive up oil and commodities prices, which will also be additive to inflation. I would not be surprised if not only do we see a second spike in inflation, but possibly an even greater one. Greg, I had some 4800 Ps this morning. I sold at the gap fill, nice. Then the other half at the 70-75 peekaboo. If I held, I envisioned you saying you didn't sell here, points to 47.75. Yeah, I mean, that's correct. I also closed my puts when we fell below 47.75. Every day this week, I've bought more puts on Nvidia and made up for my daily losses on SPX. What's crazy is I've actually been successful and remained flat. I can't believe it. Oh, that works. Nice. Well done. DZ, thank you so much, man. I made 30% of my port this week, which is my target. I couldn't have done it without your help. Thank you so much. You got it, man. Well done. That's awesome. That's like a lot. That's a high goal. I guess even if you're not streaming, your voice still haunts me. I feel like I was here for that last leg down. Weren't you positioned heavily bearish on the market in 2023? I was pretty bearish in April of 2023, and then by June I'd cut most of that and gone long. And then I rebuilt my short positions into like the end of July, and then I was heavily short from August to October. I closed out on the upside, like the upside move at the end of October and November, and I've been moderately long, mostly intraday and via straddles on the majority of this upside move. I haven't taken like a big like leverage long position at any point, but that's frankly because I didn't trust it. Oh wow, your view on inflation is very similar to mine, and among those I speak to, that's a pretty rare view. That's because everybody reads economics charts that are basically devoid of any of the meaningful additions to inflation, and then economists are look, inflation's coming down, but it's really not. They've just simply left out all the factors that are driving inflation. I don't think hyperinflation, but I think another peak in inflation. So you're saying there's not going to be 6 rate cuts this year? Feels bad, man. Actually, I think I'm saying that there could be rate cuts this year, but regardless of the rate cuts, inflation could move back up. And I think that's what I was kind of trying to point out in what I wrote last night was, that the Fed may be pressured to choose between price stability or banking stability. And that's a tough choice. This confirmation of aliens on Earth, bullish or bearish? I don't think there is any, so it doesn't matter. I keep yelling at my mom that inflation is still bad and the economy isn't good, but we're running hot and we're definitely in stag. I think that's the answer, is an extended period of stagflation where banks are able to, and I kind of wrote about this too a little earlier in the year, but I think an extended period of stagflation driven by the Fed keeping the federal funds rate where it's at, keeping dollar value and yields high, will allow the banks to get out from underwater if it can go on for 2 to 3 years until some of that fair value asset risk falls off. Remember, the average duration across a lot of those banks is like 4 to 6 years, roughly. A few more years, and they're going to be in a much better situation on their balance sheet. And if they can continue to lend against the spread on the yen, then they can continue to increase their net interest revenue. But what that'll mean is it'll probably mean a fairly cyclical period of loosening and tightening credit conditions. And some of these, like, correction, like, both the up and downside of these moves could be big, right? Like 15% over and over and over again until we find some stability. The risk is, though, is, you know, when these dive, or if Yellen starts selling duration, then we could see yields move up into that critical range where we see bank failures. And even the Fed lowering rates may not be enough to prevent that at this point, depending on how much duration she starts to issue, right? What was it the other day? The federal balance was like negative 130, with the projected at like negative 68. So, I mean, Yellen's gonna have to start selling some duration at some point, and when she does, that's going to push the top end of the yield curve up hard. And if the 10-year moves above those, you know, those targets, like 4%, 5%, 6%, those banks are going to start blowing up. So they've kicked the can, and they've kicked the can again, right? The difference is, in March, they told us. In October, they didn't. But that risk isn't going anywhere. It's there. It's just under the surface always. If Moody's moves and downgrades US debt to AA, that can shoot yields up. If the banks get further downgraded, they could be in even more trouble. SPX actual 5,000 before people realize, oh, Fed needs to step in again. No, I think we're pretty much at the upper range. And we're already seeing banks lean back into the carry trade now, right? And when they lean back into the carry trade, we're going to see those financial conditions tighten again. Why the reason the banks don't want to fully lean into the carry trade yet is because there isn't confirmation from the Fed that they're not going to cut rates in the first half of this year. But if the Fed confirms that they're unlikely to cut rates by March, the banks are going to lean back into the carry trade. Volatility is going to move back up. The dispersion trade is going to break down, and they're going to start trying to lend at those higher interest rates again. I think if rate cuts happen, we're actually going to see credit get a lot more tight than it is now. Significantly tighter than it is now. I think it'll have an inverse effect to what people expect. Mester said yesterday that they're likely to end the BTFP on March 11th. Just read the paper. It's not super complex. Everyone here can read it. Yeah. If they can't, I broke it down to make it even more simple. No, rate cuts equal banks not being able to lend. Banks can't afford to lend at the federal funds rate. Without the spread on the carry trade, they wouldn't be able to lend at all, right? The reason that credit conditions haven't tightened is because they can lend against the spread with the Bank of Japan, right? Negative 0.1 to 5.33 is quite a wide spread. If the Fed cuts rates, that spread narrows, and it creates a lot of risk, right? And in what is already a very overextended trade. Volatility shorts are smaller banks. I mean, as far as incentive goes, they're probably the same thing. It's probably not just like one bank shorting vol, right? It's all of them. They're all trying to generate yield on their treasuries. So they're buying treasuries. They're trying to average down their like fair asset value portfolios. And then they're taking those treasuries and leveraging to sell short vol, right? And so if you can sell short vol, you know, in a 20 to 30 day window, you can increase the relative yield of those treasuries, those short-term treasuries that you're buying significantly, right? So say, you know, you have like a 6-month returning, you know, like 5.4%. And you can add, you know, another 4% on top of that every 30 days. And everyone's encouraged to do this. And so that trade has become overcrowded, right? Everyone's leveraging all of that like same as cash collateral into short vol. You make it sound like free money. Well, everyone thinks it is, but there's no such thing as free money. Is there still enough put positioning to leg down again from here? Yes. And the fact that the bulls failed to hold 47.80 is kind of bearish. Yeah, I have some Tesla shorts now. Sounds like Volmageddon 2 is around the corner. Well, no. Okay, so if nothing bad happens, over time, more and more risk will be pulled back, and, you know, short vol will slowly collapse, right? The problem with the current state of things is if anything bad happens, any catastrophic event, anything in the credit markets, anything that would drive demand for a tail risk hedge or for volatility can blow everything up. I mean, we've looked at spent a lot of time looking at like the correlation between cash VIX and the VIX futures contract in front, right? It's negative. It's almost negative 40%. It's the most uncorrelated VIX and the contract in front have been since, well, forever. Actually, it's in the history of VIX. It's the most uncorrelated it's ever been, and that is a way of visualizing the size of the short position, right? Even in Volmageddon and the flash crash of 2010, there was less. There was less volatility shorting than there is now. It's the IRL infinite money glitch, and Japan has the power to collapse it for all. Well, that's one of the problems, right? Is that Japan, although they've, been very conservative and avoided collapsing the carry trade so far, and may continue to avoid collapsing it for a little while longer, do intend to move to positive interest rates this year at some point, right? Which could leave a very narrow window for banks to keep leaning on that trade.